at 399.40 on a 10-year right now in the FX market. Euro not doing much, a bit weaker going into the ECB next week. We're negative 0.1% on euro dollar, 98.33, and crude up 0.1, 85.55. As we reported overnight, Tom, that we could get another SPR release from this White House, maybe getting that announcement later this week. And can we just tally up things so far? We've had 180 million barrels released from the SPR.
It's just different than my youth. I mean, I guess Bill Clinton was the first one to get out here with the experiment of a release, and this is very, very different. Granted, a war in Ukraine, but I'm going to barbell it, John, $86 on American oil, $92 on Brent crude, and obviously you mentioned this earlier. It's the election, but
sure,
are those elevated prices? I don't know. Rhetorically.
The question I'm asking is how vulnerable are we to the whims of OPEC Plus next year if we've drained the SPR? Is this a one-off shock that we get over early next year and we can move on from, in which case this is an appropriate use of the SPR to get over a short-term one-off shock to cover a flow issue? Or is it something bigger than that? And if you believe it's the latter, then we're exposed next year and a little bit more vulnerable, Tom, than we otherwise would be.
We will see. Right now on GDP, and of course, this coming off the bang-up Goldman Sachs earnings and what we've seen, futures up 70. The VIX really doesn't move yet, 30.85. We get a view on the economy with Stephen Risciuto, Chief U.S. Economist at Mizuho. The tag team of Risciuto and Constam, outstanding at Mizuho. Steve Risciuto, I want to talk about the hope and prayer that inflation will come in. We're beginning to see glimmers of goods inflation coming down off of all the pandemic gyrations. Do you model that goods inflation can get back to a strong disinflation, or dare I say deflation?
Well, really good question. I think the answer to that is after we get through this cycle, there is a reality that is going to settle in that the world still exists in excess supply. And that, in fact, through the diversification of supply chains, we've probably amplified that excess supply, especially against the backdrop of global decelerations in growth that are likely to be sustainable, not just in the U.S., not just in Europe, but also in China. And the net result is, since we haven't destroyed the capacity as a result of the COVID shock and the latest inflation and the results of that, we're going to be sitting with too much capacity at some point in time, and that will drive down good prices and will lead to a deflationary bias down the pipeline. But the key, I think, for you is this going to lead to near zero interest rates again? And the answer is probably not.
Doug in Florida grilled the New York Yankees this afternoon, 4 p.m. He emails in and says, ask Risciuto about housing. How does housing fold into service and goods inflation?
Well, I mean, housing is a critical part of it. It's one of the most interest rate sensitive sectors of the economy. The automobile space is the other side that's very, very interest rate sensitive. And we're seeing problems developing in both of those spaces. And yes, as demand gets pulled back, those are big ticket items. Those are items that get reflected very, very quickly in terms of the chains of production. And I think those are part and parcel of what we're experiencing in terms of the downward draft that we're already getting in terms of goods inflation. We're still struggling with the service inflation component of this, however.
Steve, you said something that I want you to elaborate on, that we're probably not going back to 0% interest rates again in the near future. What is the baseline interest rate that you see as where we end up once we're out of this inflationary and then disinflationary period?
Yeah, I think it's around 2%. I think it's consistent with the underlying trend rate of growth in the economy as to where real short-term interest rates have to be. The near zero interest rate environments occurred in an environment where we had systemic credit issues that had to be corrected in the economy, and therefore you needed to create abnormally low levels of interest rates to correct that problem. In this environment, we don't see those structural credit issues. There are going to be companies that go bankrupt. There are going to be financial institutions that have problems in here. But if you go back to areas like 1975, where we didn't have systemic credit problems really dominating the business cycle, we had upwards of 140 financial institutions that needed to be resolved and 2 insurance companies that needed to be assumed by other insurance companies. And we didn't have a systemic credit risk. So there are going to be, casualties as a result of this, but they're not going to lead to a systemic credit crunch environment.
The casualties, Steve, how much is that going to be the fiscal programs of a lot of developed markets? How much are you going to see a massive program to reduce debt in the developed world?
Well, there is no doubt that there's a lot of debt that has been accumulated, but also keep in mind, for most of these governments, including our own, a lot of the debt has now been internalized by central banks, and therefore, in our case in particular, all that interest expense gets credited back to the U.S. Treasury, and therefore is pretty much of a net wash. I don't think we're going to really reduce the debt as much as we are going to allow the economy to grow around the debt, which means we're not going to be able to go through expansive fiscal policy programs for quite some period of time without having it being reflected in long-term interest rates.
Hey, Steve, you're one of the best. It's always great to hear from you. Steve Rashuda there of Mizuho on the latest. Did you see the Mohamed El-Erian tweet yesterday? It got a ton of feedback. This one was fascinating. Here it is for you. An independent Federal Reserve is critical to the well-being of the US economy. Having said that, it is getting harder to justify such independence when 4 big operational errors of analysis, forecast, actions and communication are accompanied by a lack of accountability. Lisa, your thoughts?
Well, first, to just clarify, it does not seem like he is, and his clarification saying that the Fed should not be independent. But the issue is, how much credibility has the Fed lost, and how do they need to regain it in order to protect themselves against losing said independence because of the faith that they have lost in some of these errors? It's a massive issue, and you're seeing this certainly with the political sphere, and you're going to hear that with more Elizabeth Warren discussions around what they're doing.
And Sanders too, without a doubt. Tom, I messaged Mohammed last night about this. Effectively, what he's trying to communicate here is that the errors that have been made have invited criticism and pushback around the central bank's independence.
I take real issue with this. I think Ambrose Evans Pritchard, who Mohammed and I know well, did a tour de force in the Telegraph on this. The traditional theory and the construct of it, including the Phillips curve, and as the laureate Krugman mentions, the Beveridge curve, they don't work in a pandemic-adjusted regime shift, to use Bullard's phrase. And with that, they're flying blind every moment. They've made mistakes, no question about that, but it's not within a normal, theoretically founded structure. It's original. They're allowed to make mistakes.
To Lisa's point, Senator Sanders, Senator Warren, this is all just getting going. This is the beginning. It's not the end of any of this. When you start to see unemployment go the other way and the Fed comes out and says, yeah, this is the objective, we've got a problem.
And this is going to be an even bigger discussion when you go to the point that we were just talking about, where you have basically monetized fiscal budgets, and that's something else that's an issue.
Equity futures up 1.8% on the S&P. Live from New York, this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The Fed is still the central focus. And when it comes to the dollar, there's a lot of concern.
Clearly, inflation is becoming more entrenched.
I think it's in February and March. That's the sort of timing I have for dollar weakness to come back in.
The Fed is on a mission. This is a very intentional and aggressive tightening of domestic monetary conditions.
This is a long, drawn-out, multi-quarter economic downturn, not something that's going to reverse quickly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Jamie says business is okay. Brian says business is okay. David says business is okay. John, there's a theme here.
And don't forget Jane. Jane says the US economy remains relatively resilient. So every single chief on Wall Street is basically telling you the same thing. 3Q is okay. Business is doing okay.
And we saw this the last quarter as well. And the one is, I guess it's as Bramo says, it's the view forward in the conference call. And we'll have to see what they say.
The view forward is uncertain. It is uncertain. And if you want to get bullish, the ultimate lows, according to Bank of America and Mr. Hartnett, front half of 2023. No cuts, no party. Seems to be the story.
Everybody just in. We look at equities, bonds, currencies, commodities. We'll do that in a minute here. A fairly quiet day. But, John, not quiet in the United Kingdom. Continued volatility for Governor Bailey.
I mean, I can't keep up. So the FT came out overnight and suggested this Bank of England was ready to delay QT. Then the Bank of England came out several hours later and said that report was inaccurate. So, Tom, you decide. And sterling in between has been absolutely whipsawed. The Prime Minister's just about hanging on. We've had basically the budget. You'll get the full budget at the end of the month. And the Bank of England's going to make a decision in early November to hike interest rates, Tom, maybe by 75 basis points, perhaps even more.
Lisa, you featured earnings earlier in the brief, and to me it's the arc of the elites doing really well and a whole bunch of other people really struggling here within the UK, the US, and frankly the global economy as well. It looks like it's two global economies.
Which is the reason why it's going to be even more political as the Fed continues to tighten rates in response to the inflation and the persistence that you're seeing, particularly with people who do have more money that are spending it. And we talk about how it's an uncertain road forward. The earnings have been looking good. And so right now you're having a 4.93% Fed funds rate being priced into the market as of March 2022. What does that do to the economy? 2023. Yeah, I lose track of these years.
But still, that's on the edge of 5%. And, John, we're not framing that.
Look at this rally. 1.8% on the S&P 500. We had a monster move yesterday, and we're adding to it. Bear market rally. I think that's what many people are calling it. Mike Wilson and Morgan Stanley expected it.
Okay, Wilson's been very good on this, and some of the bulls are adjusting. We'll get to that in a moment. Andrew Sheets with us in a moment. John, let's start the data. I'm going to go to yen, which is in, I guess, intervention territory, 149.13 on the edge of 150.
Kick it off with equities. Get the board up. Equity's absolutely flying. We're flying here again, up by 1.9% on the S&P 500. Futures up 69. Yield's not doing much, in and around 4% on a US 10-year. At the front end of the curve, through 450 last week. And the conversation we've got to have, how much scope is there for more upside on pricing this Fed terminal rate? You said we're close to 5 right now. How much further are we willing to push this?
But that's not the issue, right, that people are talking about, particularly Peter Scheer. He's talking about what's the weakness that would have to be seen for them to pull back from this, and how is that going to be priced? And I almost got the sense that once we treat bad news as bad news, that possibly is when we start to get the capitulation that everyone's been looking for the next cycle to start.
Just the Bramo concept.
Well, what do you make of how we're treating the data so far? We had that monster upside surprise on CPI. And then we rallied really, really hard, and we're doing the same thing again this week.
Dow futures up 500 points just to get your attention.
Thanks,
the
Tom.
Bloomberg Financial Conditions Index, 1.5 to 1.2. It's less restrictive. And this morning, Andrew Sheets knows that. He's Chief Cross Asset Strategist at Morgan Stanley and joins us. It's going to be an amazing set of meetings, Andrew, at Morgan Stanley today to recalibrate into November. Take the jumble and make sense of it. How do you recalibrate to the end of the year?
Well, thanks, and it's really nice to be here with you guys. So look, I think you have an overlap of a tactical story with a bigger strategic story. Tactically, as you heard, my colleague Mike Wilson turned tactically bullish on the S&P as of Sunday night. He sees the potential for a rally to 4,000. A number of the tactical indicators that we follow do suggest a market where sentiment's pretty negative. Things look oversold. Maybe actually earnings season after a lot of negative guidance turns out okay, and you're into a window where seasonality for risk assets is often somewhat better. But big picture, we still have growth that's going to be slowing over the next 3 to 6 months. We still have a lot of monetary policy tightening ahead of us, even if markets don't price anything in additional above what's already expected. So, and you still have earnings that we think in the U.S. and Europe will need to be revised down, in the fourth quarter or the first quarter next year. So I think the way to think about this is a bear market rally. It's short, it's sharp, it still matters, but the big picture hasn't changed, and there's still work to be done, I think, before we can say this bear market's over.
Andrew, to Lisa's point, we've priced in a big rate hiking cycle. Maybe we haven't started to price in the consequences just yet. What do you think the consequences will be, and can we put some numbers on it? I hear this short, shallow nonsense all the time. I have no idea what it actually means. Andrew, what do you think it means?
Well, I think it means that you could see a downturn that matters a lot more to earnings than it does to GDP. That we've been through an environment where goods consumption has soared relative to services consumption, the type of economy where kind of everybody buys a barbecue and nobody goes to the dentist, so to speak. And that's a type of environment that is generally good for earnings. The S&P 500 global equities are really good at monetizing goods and turning them into earnings. They're a lot less good at monetizing services and turning those into earnings. So I think you could have an environment, if you look at those consumption series, where goods demand comes down, services demand holds up pretty well. The overall GDP effect is pretty modest, but ultimately the earnings impact is larger. And to be more specific, housing is so important to goods demand. Think of it, every time somebody moves, people buy furniture, they buy electronic goods. There's a lot of stuff that gets bought in a housing transaction, and yet given this move in rates, we're seeing housing transaction volume really decline, to some of the sharpest deceleration we've ever seen.
How much are long-dated bonds the best haven right now if people are starting to think that perhaps we're pricing in peak Fed, we're pricing in a Fed that gets as aggressive as we've seen for decades?
Well, I do think you've seen more value come back into the long end of the market, but again, I think you also have some challenges there where you're dealing with a pretty high vol asset class, and I think there's some really legitimate uncertainties around where kind of new neutral rates are going to be, and also where, what is the type of kind of real interest rate that's required to slow the economy, and I think we still kind of don't really know that. And I think there's a genuinely large cloud of uncertainty out there. So I think it's probably still a little bit too early to kind of go into the very long end of the curve. But, one asset class that we think has a good kind of risk reward combination here would be something like 1 to 5 year corporate bonds in the US. They yield about 5.5%. That's not that far away from the earnings yield of the S&P 500. and is an asset class that we think can still provide, some pretty decent income, above what we think inflation is over the next 12 months, while still providing some ballast and less volatility than other things.
Andrew, just one final question. The number that jumped out for me in your latest report, Mike Wilson's from over the weekend, was just how far you think this bear market rally can go. Something like 4,100. Now, Andrew, that's a big monster move higher. And Andrew, I wonder, when you look at that, at what point would you look at it and say, oh, maybe we're not right about this. Maybe this is more than just a bear market rally. What would tell you?
Sure. So I do think the inflation numbers are very important. If we see positive surprises to inflation, there is a lot of good that can come from that, right? Then the market can start to think maybe the Fed doesn't need to do so much. Maybe we can start to see the Fed backing off, and that relieves pressure from rates, which can swing back into equities. I think seeing labor force participation continue to climb, that would be quite good, suggesting the supply side of the economy is stronger, that we can have more growth for a lower level of inflation. And then on the earnings front, a reason why we've been cautious has been around the view that margins will come down ultimately, and earnings estimates will come down. Maybe the inventory problem is better than we expect. Maybe companies are able to defend margins through cost cuts that don't impact the broader economy to such a negative extent. And I think that's where the bull case lies.
Okay, Andrew, you and the team have just been absolutely awesome this year. Appreciate it, as always. Andrew Sheets there of Morgan Stanley. Appreciated what Andrew had to say there. Drew a distinction between GDP, short and shallow, and earnings, maybe not short and shallow. Tom, there's a difference.
Well, there is, and I'm going to go back to this on the revenue dynamic and down the income statement. You can choose it, and it's different sector to sector what happens on the income statement, but they're going to adapt, as Mr. Sheets talked about at the end there. It's going to be one part pricing power, which we all know, and it's going to be one part cost cutting. And you know what? They're going to get to the other side.
Drew Madison MetLife writes in on a Bloomberg. Lisa, he says short and sharp, not shallow. That's the pushback.
Yeah.
Get a lot of.
Well, and this is sort of the economic play, but just going to what you're talking about with earnings, how much, going back to what Steve Rasciuto said, do we have to reset corporate performance and the earnings in a 2% Fed funds world? If that's where we're heading back to, it's not a 0%, it's 2%. How much do you take away from the momentum of the financialized world and potentially give back to the real economy?
BofA's fund manager survey today, the theme of it was capitulation. And if we can push that just one step further and build on what you just said, I don't think people have capitulated at all on the view about where we go after all of this. The destination. The destination for so many people still is to go back to the pre-pandemic playbook of low rates, low growth, low inflation. And Tom, that's a view that we have not capitulated on.
This is how far down we are, and to your point, and I agree on capitulation. I'm not going to use Dow points up 523. I'm going to look at SPX up 73, 3,700 rounded up 3,800. 2 standard deviations. You don't even get through resistance until 38.42. We're still distant.
How many times are you going to squeeze Dow points into this segment?
That's what America cares about. We look at Dow points and we know we're distant from 36,000.
You're going to keep this up, aren't you?
Yes.
I can tell you're in the mood for it.
It is.
Coming up, Michael Nathanson, founding partner and senior research analyst at Moffett-Nathanson. I noticed that in the weekend. I almost cancelled my journal subscription again.
That's what we do.
What, Dow points?
Yep, Anaconda Copper. Westinghouse.
What year is this?
Oh, 1940.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Just 10% of Britons have a favorable opinion of their Prime Minister Liz Truss. That's according to a YouGov survey. Now, the results come one day after Truss was forced to pull back on the bulk of her economic vision for Britain. Some 80% said they had a negative view of Truss, giving her a net favorability rating of -70. Russian missile and drone strikes targeting Ukrainian power infrastructure over the past week have failed to knock electricity supply off the grid for any prolonged period. That's according to the International Energy Agency. Now, hundreds of recent strikes have targeted power plants and electricity substations across the country. The Biden administration is moving forward, releasing at least another 10 to 15 million barrels of oil from the nation's emergency stockpile. The move is said to be meant to balance markets and keep gas prices from climbing even further. The Strategic Petroleum Reserve release would be the latest in a 180 million barrel program that began in the spring. AT&T is counting on stimulus dollars to help fund its broadband push. The wireless giant wants small towns to use federal economic recovery money to cover the cost of landline high-speed internet to rural and remote areas. CEO John Stankey met with local politicians and residents in Indiana about using American Rescue Plan money to cover a portion of its fiber network expansion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships and working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
The old system of stimulating your way out of any kind of recession or financial market pain isn't being allowed. You're in this scenario where you're going to have a slowdown, you're going to have pressure, you're going to have credit cracks, and the federal government and central banks can't come to the rescue as quickly
Love Steve Cheverone, always great, the head of multi-asset solutions at Federated, joining us just yesterday from New York City this morning. Good morning. Equity markets pushing higher, Goldman numbers doing okay, futures up by more than 2% now on the S&P 500. This is a really big lift going into the cash open off the back of a really big dev gains yesterday. Yields are lower by 3 or 4 basis points. We're down 3 to 397.98 on a 10-year. Goldman behind us, Tom. Netflix still ahead. Those numbers after the close. That stock is down by 59%
well, they're
year
going to
to
be
date.
bailed out. They're going to have the conference call, and they're going to talk about the new Hollywood property they've got at Netflix called Dead Cat Bounce, and we'll see how that goes. Maybe that'll be like the Queen's Gambit. We need to get an update on entertainment. Always, we can do this with Craig Moffett and Michael Nathanson of Moffett Nathanson, a division of SVB, and we're thrilled that the Wellcroft Nathanson could join us this morning. Michael, I'm going to digress here to when the thud you heard was me falling off my chair. Is Mr. Murdoch wants to piece Humpty Dumpty back together again. What did you think when you saw young Murdoch said, let's bring it back together again?
Yeah, that was not the playbook we wanted to see.